Hey, check it out, my Tesla has race car tires.
See, look, flat like a race car.
Don't worry, I'm getting them changed.
Well, you might be wondering, why is Kevin posting twice in a day, and why is Kevin walking around with a flower cup this time instead of the usual Don't Sue Me Bro cup, or the Halloween-themed Don't Sue Me Bro cups that Kevin hasn't even mentioned yet? They just happen to appear in the store linked below. Well, that is because my credit card video absolutely bombed that I spent a lot of time and research on. You should definitely go watch it. But apparently people didn't click on it because the YouTube Creator Studio, in case you don't know, the YouTube Creator Studio told me that fewer of my subscribers are interested in clicking on the video, but people are watching it longer when they do click on it. In other words, the clickbait sucked even though the video was good. And then YouTube ranked it a 10 out of 10. And in case you don't know what a 10 out of 10 is, a 10 out of 10 means it was your 10th best video out of the last 10 videos, aka it was the worst video I have posted out of the last 10 videos. So anytime I see like a video ranking less than a 5 out of 10, I get pretty sad. And anytime I see a 10 out of 10, I get a flower cup because misery loves company and I'm miserable. And that's why we're gonna talk about why cash flow should also make you miserable. Now, I know this might sound like blasphemy because most of the time we're thinking to ourselves, wait a minute, Kevin, cash flow is what is going to make me financially independent and able to retire early. But it is not cash flow that will enable you to do that. And I know how juicy it might seem to receive that mailbox money and make money while you sleep. But there are 3 main reasons why cash flow is actually a miserable source of income. And what you should be doing instead is what we'll follow up with. And then I will talk about when cash flow becomes very desirable. But for 99% of you watching this, it's not now. So let's just get started on why cash flow sucks. Number 1. Oh, and quick note, don't think I'm just gonna give you 3 reasons why cash flow sucks and then start playing my closing music. No, I'm actually going to tell you when you want cash flow, but what you want instead most of your life. The number 1 reason cash flow sucks is a taxation. Now, if you're lucky and you live in a wonderful state like Texas, which doesn't charge you a state income tax, this means you might be paying somewhere around 25 to 30 cents on every extra dollar you earn from cash flow in taxes to the government. Now, keep in mind, where are you gonna get cash flow from? Well, usually it's going to be rental income above and beyond your expenses, dividend income from stocks, any kind of dividend income from dividend index funds. Like if you invest in Vanguard's VDIGX, which is Vanguard's dividend growth fund, or maybe you made a loan to some people and you collect interest, or you buy bonds and you receive interest from those bonds. These are all different forms of cash flow. The problem is most of us have our job, and then we earn our cash flow on top of that, which means our cash flow actually gets taxed at the highest marginal rate. So going back to Texas, if you're lucky and you make $1,000 of extra income in mailbox money and cash flow, you might see somewhere between $700 to $750 of that end up in your bank account. Now, obviously, this is just a YouTube video, so always confirm this information with your CPA. But if you're unlucky enough to live in a state like California, where your marginal tax rate might be somewhere between 40 to 55%, depending on your income, making an extra $1,000 of passive income, cash flow, or say course revenue, if you buy my real estate investing course or agent course, might only leave me with about $450 to $500 in my bank account. The government absolutely loves your cash flow and dividends because they are your favorite business partner. Now remember, I'm not just going to bag on cash flow, I'm going to give you some solutions here, but taxation is one of the worst reasons to want cash flow. The second reason cash flow is frustrating is because, in my opinion, it tends to be a wealth limiter. That is, the more cash flow you squeeze out of whatever assets you have, the less money you're probably reinvesting to grow your portfolio. Now, smart and savvy investors will say, well, wait a minute, Kevin, I take all of my dividends and reinvest it. And that is perfect. If you take your dividends and reinvest it, that's excellent. However, let's take real estate for example. If you own a cash flowing property that gives you cash flow of, let's say, $5,000 because you own an apartment building and you have a $5,000 cash flow, you could leverage some of the extra equity that you have in that building and purchase another apartment building to grow your wealth over time. Now your cash flow will go down, but now you have 2 buildings on the ride of real estate appreciation and real estate wealth building. because you can obviously buy these apartment buildings getting what I call wedge rent deals, which we talk about in the course. You could get wedge condition deals, which we talk about obviously on this channel all the time, how to get single families in cosmetic distress. And so in other words, the more cash flow you have, usually the less aggressive you are at building your portfolio. So it can actually be said that yes, while on one hand, extra cash flow might be a level of security, which every property you should buy, you should endeavor to have a cash flow. Having too much cash flow can limit your growth and limit your wealth building strategies. So that's why oftentimes you hear of the BRRRR strategy in real estate, where people will end up refinancing to take their cash out through a cash out refinance, reduce their cash flow, but then give them that leverage ability to go buy more real estate. Obviously, there are risks to doing this. I recommend you keep a certain amount of cash flow for conservativeness, and I'm actually one of those people that usually encourages you not to refinance. But I want to go through the 3 reasons why cash flow is a negative, and then show you what you should be doing instead. The third problem with cash flow is while most people say they're going to reinvest their money, unless you actually have automatic reinvesting set up with wherever you're setting up your investments, for example, if you're in Vanguard and you check the box to automatically reinvest your dividends, unless you do that, you're probably not. That is, most people who invest in dividend stocks just let the cash grow in their TD Ameritrade account without ever realizing that, dang it, I need to go reinvest those dividends. Or worst case scenario, you get the check in the mail, like from Cardone Capital, you get your little distribution, and then you just end up spending the money on dinner because you go, ha, I made a little bit of money while I sleep, and that just paid for my cheesecake dessert, as it didn't pay for much else. Okay, I'm obviously being extreme here. I'm not trying to slam Cardone Capital. But so now we've talked about the 3 big problems with cash flow. You get taxed out the butt. You limit your ability to really build wealth and grow the more cash flow you have. And the third reason is it takes effort to reinvest your dividends. And unfortunately, a lot of people don't either remember to, don't automate it, or just end up spending their cash flow. So cash flow can come with 3 major issues. But what should you be doing instead? In my opinion, the most financially sound thing that you can do in life is focus on building your net worth first, and then cash flow will follow. Too many people get this backwards. Too many people start with the idea that, well, I need to have cash flow today. Screw my net worth. What's my net worth going to do for me? I just want cash flow right now so I could go sit on the beach in Tahiti. Unfortunately, those are generally the people that don't have a lot of cash flow because they don't have a net worth. Let's just show this as an extreme example. If somebody has a net worth of $100,000 compared to somebody who has a net worth of $5 million, and both of them receive 0 cash flow, who do you think will be able to get cash flow faster? And why might it be set up like this? Well, let's say both of them own a break-even real estate building. One person owns a building that has $5,000 in equity, but for some reason, it's a break-even. The rents come in, the expenses are so high, and it's a break-even. It's just an example, okay? The same thing with a person that has a net worth of $100,000. They own maybe a $500,000 building, $400,000 of debt, $100,000 of net worth. Also, no cash flow. Both of them, no cash flow. Now, you might be asking yourself, well, both of them have no cash flow, so they're on equal playing fields. But that's wrong, because it always comes back to the net worth. Because somebody could easily liquidate both of these properties, take $100,000, go invest it into even something as simple as a dividend fund that might return you 5% on your money, and take that $5 million and throw it into that same dividend fund. Maybe after expenses, they have a little bit less, but whatever. Obviously now, who has more cash flow? It goes without saying, but the person with $5 million in net worth just converted his net worth into $250,000 of cash flow every single year. The person with the $100,000 net worth just converted into $5,000 of cash flow every single year. Now, I know this might seem like, well, wait a minute, I mean, that's not really a fair comparison, but it actually is, because people who generally focus on only cash flow their whole lives don't end up growing a large net worth. People who focus on net worth first, they're the ones who usually end up with the cash flow when they want it. So what's a quick primer on my favorite way to build wealth in life? Well, my favorite way to build wealth is you buy a building of real estate. This could be a single family, it could be an apartment building, it could be 100 units. I don't really care what it is, but I don't want you to overpay for that building. What I'd rather you do your entire life, I'm gonna show you this as just a quick example and it's gonna be great. What I'd rather see you do is buy a $500,000 house that's going to be worth $700,000, and all of a sudden you have this benefit of an immediate gain of $200,000 in net worth by controlling a property like this. I bought 3 of these properties this year alone, and I'm only 27 years old, so it's possible. Don't compare me to these like 60-year-olds that have been doing this for 30 years. I'm just some 27-year-old dude on YouTube in a purple office drinking out of a purple coffee mug, showing you how I plan to build wealth, and already have. Then as better opportunities present themselves, I want to convert this into another building of real estate. And what I'm going to do is if I sell this property, I'm going to do something called a 1031 exchange. And guess what the government does then? They're not going to tax me on the gains that are in this property. For an oversimplified example, because obviously there are expenses and there are some other things that go into this, but for an oversimplified example, let's say I now move that $200,000 in net worth to this next property. That maybe this next property I bought for $2 million and it's worth $2.5 million later. So now I have somewhere around $700K in net worth built into this new property. Well, if I now go sell this property again, and over my life I do this over and over and over again, and I end up with a property portfolio that's worth $10 million, but I have accrued $9 million of total gains in that property, you might be thinking to yourself, well, Kevin, you got lucky. You did a 1031 exchange and you told the government, hey, you know what? I'll catch you later. I'm not going to pay taxes now. Hey, government, I'll catch you later. I'm not going to pay taxes now. I'll catch you later. And the government might have said every single time, hey, you know what, Kevin? No problem. You keep providing housing for people. You keep doing you. You keep investing in real estate. We're not going to tax you on you building your wealth yet. Meanwhile, while I'm building this portfolio, I'm in my earning years and I'm not interested in retiring yet anyway. Now, currently, I own about $6 million worth of real estate, but let's say I have a portfolio of $10 million of real estate at some point in the future if I want to retire at 35 or 40 or whenever I want to, and let's say $9 million of that is taxable. I kept telling the government, hey, I'll catch you later. Let me get back to you on taxes. What options do I have now to actually live retired? Well, the very first thing I could do is something I mentioned earlier. I could refinance or I could take out debt, and when you take out debt, you don't pay taxes. So I could actually now take out, let's say, $250,000 of debt and live for a couple years paying no money in taxes. And I know you're thinking, but they're gonna get you later, they're gonna get you later. The other thing that I could do is if I retire, I could choose to start increasing my cash flow by maybe reorganizing the way I've structured my portfolio. And I could decide to take, you know what, I'm gonna take $50,000 a year of cash flow, which is going to be taxed a lot less if I'm only making that $50,000 in cash flow, or that $150,000 in cash flow, or $250,000 in cash flow, whatever I want. I'm going to be taxed a lot less on this cash flow if that's the only money I'm making. See, what I mean is I don't want to make $150,000 as a family at my job and then earn $150,000 in cash flow on top of that, because now my cash flow gets taxed at the most money and my regular income gets taxed at the lower brackets as it sort of goes up. This is the difference of your marginal tax rate. That's why I'd rather only take that cash flow when my job is gone and I'm ready to retire. That way I'm actually paying less money in taxes on my cash flow. Now, at this point, you might be thinking to yourself, okay, that's interesting. So you're saying you don't want cash flow as you're building your portfolio and as you're working and you're employed because you're going to get taxed at a higher amount. You're more likely to spend it and it's going to limit your ability to build wealth. But when you're ready to retire, having a net worth makes it easy to convert your funding into free cash flow, which will now get taxed at a lower level. Bingo! But there's actually something more interesting to this. See, as you build your real estate portfolio, and you continue to build all of this net worth, you have a lot of money that you're going to have to pay taxes on. And a lot of people say, oh, well, Kevin, you know, when you die, if you get hit by a bus tomorrow, your family's gonna have to pay taxes on this $9 million. the government's going to get you. Even though you might be living off your cash flow that you're kind of controlling like a cash flow valve because you've got the net worth and you're trying to minimize what you're paying in taxes to the government, they're going to get you eventually. Fortunately for those people, they're wrong. Watch this. If I got hit by a bus and I had a $10 million real estate portfolio, $9 million of that was taxable, the government comes in and says, hey, Kevin, we're so sorry you died. You don't owe us any taxes anymore. That's right. Your family gets a stepped up tax basis on that $10 million portfolio, which means my family never pays a dime of taxes on that money. Now, obviously, dying is not a tax strategy, but cash flow is a bad tax strategy. Thanks so much for watching, and until next time.